I didn't think it would take you too long to pop your head up again after the VWRL rise. YouTube is coming back, not around in the hard times. As soon as the markets improve, they are back. What a surprise.
Well, Lawrence and Adamson, if you think that's bad, just wait until you see the vast amount of trading 212 content you're about to see after they now allow new users.
Hi guys, so I just wanted to let you know that if you've been waiting for Trading 212, then they have reopened their registrations finally. So you can use my link if you want a free.
So I've had a little bit of time off because apparently the markets have been down. But if you're new to my Vanguard portfolio updates, then this is where I transparently show my real life Vanguard portfolio with all its ups and downs over the last 5 years. No fake portfolio here. But alongside that, I give my general thoughts on various topics around the stock market, notable happenings, and anything else which catches my eye. In particular this month, I want to highlight why British investors are being particularly shielded from the trauma we're seeing in the stock markets right now, and why it actually might not be a great thing in the long run, before heading into my very own portfolio update, which I haven't actually done one since June, so it's long overdue. So the first half of 2022 was possibly the worst first 6 months in the stock market ever recorded. So it's very odd that when we look back to this point last year, we're actually only down 3%. Yes, that's probably around roughly 7 to 10% lower than we expect on an average year, but then again, we've only lost 3% and it's one of the worst starts ever on record. It's not that bad, right? And then on top of that, if you'd actually continued to buy quite often over the last 12 months, then you're actually probably still in a profit, even though the markets had gone down. For me, my profits 12 months ago were about £14,500, and right now they're around about £15,700 mark, which is primarily because 1, I've been receiving dividends, and 2, because I've continued to buy shares at a lower price, I've actually probably made some profit as the markets have slowly recovered a bit. So I could smugly sit here and boast how somehow I've made £1,200 over last year when it's one of the worst investing periods in history, but this would be extremely misleading to say the least. The first of the 2 reasons is the 9-letter word that none of us can get away from: inflation. Normally, when we hear inflation talked about in the media, it's all about how much food costs or equally how much it is to fill up our car. But as investors, the real damage to us is that any profits that we have made in the stock markets are equally losing their purchasing power over time. Take the example I've just given. This time last year, I'd made £14,563. And then this year, I've made £15,717. On face value, you'd quickly take this figure here as it's higher than the other, but that would be incorrect. If we use last year's total and anchor that value by saying that that is roughly how much it costs to run my house over a year, so living expenses, so food, rent, and all that jazz. Well, based on the current level of inflation in the UK, which at the moment stands at 10.1%, if I wanted to buy the same goods I did last year with that money, I would now need to have £16,019 to buy the same amount of goods. I'm sure you can already start to see the problem. Even though on paper I've increased my profits through investing, I am actually comparatively worse off. But for me, that's actually not the largest concern I have of the performance of VWRL or even any global ETF over the last year for that matter. My main actual concern is foreign exchange rates. You know, the thing that this slimy ball is going on about all the time. It's normally something I don't pay much attention to as it's fundamentally out of our control. And most of the time it has very little impact on investments as it doesn't change that rapidly. The reason it affects global ETFs is by the very nature of owning companies from all over the world, as these businesses trade in different currencies. Some earn their profits in dollars, some in euros, and some in yen. You get the picture. But when it comes to valuing our own portfolios in the UK, we need to convert all those foreign currencies into sterling. The problem that can arise is that the value of sterling can constantly fluctuate against foreign currencies, meaning that on any given day at the moment, you'll either get 62p for every 100 yen, or it might be 61p for every 100 yen. But as you have a global portfolio, you can imagine that a lot of movements in currencies normally cancel each other out, meaning that any given day, the difference is very small. The problem we have now, though, is that this is no longer a small difference. The easiest way you can tell that something is fundamentally different right now, from our point of view as British investors, is if we look at the US economy, we can actually see they're performing very poorly over last year versus our own global ETFs. As said before, any decent global ETF is roughly down 3% versus the same time last year. But if we hop over to look at the performance of the S&P 500, it's down 13%. You'd be forgiven for thinking that US companies must be just purely underperforming at the moment. After all, if US companies only make up 60% of any global ETF, and it's relatively down 10% versus a global benchmark, then this would logically mean that the rest of the index is just up. So the rest of the world must be up, I don't know, roughly 20% versus the average performance. But if we look at the other main indexes across the rest of the world, so the FTSE 100, the Euronext 100, or the Nikkei 225, you can see that year-on-year performance is roughly between down 10% to only being 2% up. So what the fuck is going on? Well, it's actually all about the dollar, and it growing rapidly in strength over the last year. Just in the last 12 months, the US dollar has strengthened by 20% versus the pound. So for every $1 last year, we used to get about 72p. But now 12 months later, in September 2022, we are now getting an additional 15p. So we're getting 87p for every $1. But why does this matter? Other than making a trip to Disney World 20% more expensive, it fundamentally means that the profits from 60% of our portfolio, which is made up of US companies, can earn the same amount of money, which actually earns us more once it's converted into sterling. So for example, $1 million of profits last year was worth £720,000, but it's now worth £870,000. This in turn means that US companies are now more valuable to us Brits, and is now increasing the value of our global ETFs. If you know anything about economics and fiscal policy, then you'll be thinking, how the hell can the US print 20% of all dollars ever just in 2020, which logically would devalue their currency because there's more of them, so more supply and the same demand, and then it actually strengthen over the following years? It doesn't make any sense. Well, the reason behind this could be a video within itself. But if you want to learn more about this, then I'd actually highly recommend a great video from my friend Cobweb and his pet Damien, which discusses the dollar smile. I'll put a link in the description, but go and tell Cobweb I said hi. So, where does this leave us now? Well, to be honest, no one really knows. We've actually seen the pound this week once before, back in the 1980s, but without going to a full-on history lesson of what happened, it quickly crashed back down afterwards. I actually tend to think about these financial factors a little bit like an elastic band. Naturally, a rubber band will want to stay at an equilibrium in the middle. If you stretch it, it'll want to go back to the middle. If you squash it all together, it'll then spring back out again. Historically speaking, going back over the last 40 years, the average exchange rate is about 41p to every dollar, meaning that is about the equilibrium we're used to. However, the pound and the dollar is very stretched right now, naturally feeling that you will want to pull back into that 71p mark over the long term. And there are actually plenty of economical reasons why this might be the case over the long run. But if you do believe we're going to come back to that 71p mark over the short to medium term, then you might be spooked into thinking of trading out of your global portfolios, as the dollar would weaken versus the pound, putting downwards pressure on global ETFs. Personally, I wouldn't be so sure. Rules are made to be broken. You could easily apply the same logic to the PE ratio, a ratio which is held to show when a stock or index is either under or overvalued. The logic goes that if the PE ratio is high compared to its long-term average, so the price as compared to its earnings is stretched, then it would indicate that it would be a time to stop buying or actually selling your position, because it could be overvalued. And the same goes for the reverse, where the price is actually quite low to the earnings of the index or the company you're looking to buy. But I would be careful. Looking at the long-term average of the PE ratio, it would show that the average ratio since the early 1900s is about 13 to 14, at least until the mid to late 90s. But then in the millennium, we were then introduced to growth stocks, which were naturally priced with a higher PE ratio as profits were pushed out further into the future. This then started a whole new era of investing, and if you kept the same methodology of looking at the long-term PE ratio, then you will have sold everything towards the end of the 2000s. You might have briefly dabbled in 2008 where valuations were quite low, but since then you would have missed out on 14 amazing years of return, totaling 433%. I tell this story as it's really easy to hold on historical trends as if they're going to be true in the future. And now I have reasons to believe, a bit like how the P ratio has now been broken, I can see the commonality with the exchange rates versus the dollar into the future. The US has done nothing over the last 15 years but proves to the world that it can continue to grow at a rapid rate with cutting-edge innovation and provide products that the world really wants to consume, driving massive demand for the US dollar. And in the same time period, what has the UK done? Our biggest innovation at that time is creating OnlyFans, which you can both either cheer or cry over. And on top of that, we decided to leave the EU, which by most standards is an economical nightmare to say the least. while our cousins over the sea have been changing the face of renewable energy, creating the next frontier of television and building reusable rockets. And in comparison, the best we can do is creating an app where you can sell pictures of your naked body for the price of a cheeseburger. Just let that sink in. It's safe to say that I have little to no faith that sterling will justify its demand above the dollar to the extent it has over the last 40 years. But I am open to the idea that I could be completely wrong, but that's why I buy global ETFs, so I can cover all bases. But all in all, I think it's important to note that a lot of your current performance isn't down to anything positive. Probably just more down to the UK sucking more than anything else. Anyway, onto my portfolio update. It does go without saying that this is a live account and all the gains and losses you see are very much real. To bring you up to speed, there's only 3 things that you need to know. 1, I invest solely into the FTSE ALL-WORLD UCITS ETF by the ticker symbol VWRL. There are other similar global ETFs out there, like the Global All Cap. 2, I started investing at the very start of 2018 with a bonus I received from work. Since then, I've started depositing every single month, starting around about the £300-400 mark, but I have edged that up over time where I invest about roughly £940 every single month. And 3, my investing style is lump sum investing, which is commonly confused with dollar cost averaging, but purely whatever money I have left over the end of the month, I invest straight into my index. A good indicator that I lump sum invest is that any time I get a bonus, I put it all into the market straight away, just like I did earlier this year in the March-April time. Now you're all caught up, let's get into it. Back in June, VWRL had quickly recovered from a low of just under £82 back to the mid-£85, with some light relief after the markets continually trading down over the first 6 months. Unfortunately, this was very short-lived as the markets then plummeted down nearly 10% to a new low of £78. This movement actually pushed my portfolio down below £70,000 for the first time since the start of this year, and actually gave me a valuation of lower than it was back in November 2021. At the same time, my profits are then pushed back down below £10,000, which was the first time since March last year. But luckily for me, since this bottom, VWRL has charged up ever since this point, recovering all the way from a low of £78 to a peak of just short of £90,000 before pulling back just slightly. As of right now, we are sat just short of £88, which has meant my valuation has now passed the £80,000 mark for the very first time, at £80,401. It's worth highlighting that even though my portfolio is at the highest level that it ever has been, my profits aren't. Right now I'm up around £16,000, when I was actually up £19,000 back in December. So in reality, I'm £3,000 worse off than I was 9 months ago. But I'm actually not that disappointed. Throughout this whole period, I've been consistently buying shares knowing that they will increase at some point. And all the time the share price doesn't increase means that my portfolio is a loaded spring. What I mean by that is that over the last 5 years, there has been multiple times that my index has grown by more than 10% in a short amount of time. And this will happen again. And at this point, I'll probably be sat on around 1,000 shares, growing my portfolio very quickly by £10,000 in profits. Saying this though, I don't know when this will happen. I'm just extremely confident this will happen eventually. But VWRL isn't the only way I'm trying to increase my wealth. And if you want to know more about how I'm attempting to do that and becoming a millionaire in the shortest time possible, then I'd highly recommend you check out this video just here. That's all for this video. See you in the next one.